And welcome back, everyone, to another Pivot podcast. My name is Tracy. I'm so glad you could join us. And I am once again joined with my amazing co-host, Mr. Dan Jansen. How are you doing?
Doing good. How are you, Tracy?
I am amazing. And we have I'm actually really excited because we have one of my favorite options traders here right now, Mr. Robert Thompson III. He is a math-based options trader, and that's why I love him to death. Welcome.
Yeah, after the long-awaited hiatus.
Yes, absolutely.
I would assume off the bat somebody hears the terms math-based options, especially for new traders, people not involved in options, people that are a little distant from the stock market, and just go, no, the whole thing is just gambling. So what is math-based options? How would you even define what that is?
Mm-hmm.
You know, it's actually really funny, Dan, that you used the gambling analogy, because that you're not as far off as you might think. Math-based option trading is basically looking at probabilities and statistics and making those the foundational basis for your decision making. So what a lot of directional traders do is they'll look at technical analysis and or fundamental analysis, and they'll base most of their decision-making process off of those two types of analysis. But there exists a whole other world of probabilities, statistics, the option Greeks, how that all works, the pricing models inside of the exchanges, PhD level math stuff, which, by the way, I do not have a PhD in math. Okay, I just understand the strategies. But the idea in math-based option trading is to, quote unquote, be the casino, where you're basically putting on a lot of high probability trades, stacking smaller wins. It's not a home run approach. All right, so it's not the approach where you're looking to crush that one trade that's just going to transform your year. You can really only do that in the more technical directional stuff. But with the math-based option stuff, you're going to win a lot. Your goal is to try to, lose small, win a lot, and stack gains. And just like a casino, over a period of time, you put enough trades on, you will come out ahead in the end.
That's awesome. And we have been focusing this month primarily on earnings. And I think what you've told us so far is that math-based options plays really well into earning strategies. Do you want to talk a little bit about that?
Yeah, absolutely. Personally, I wouldn't trade earnings any other way than in a math-based way. All right. And that's because it's very difficult to predict the outcome of earnings. We've all seen good, strong earnings gap down. We've seen horrible earnings gap up and run. It's just sometimes it's a little bit of a crapshoot out there, right? So I think one of the caveats that we should talk about is the idea that it is difficult, in my opinion, to build a long-term cash flowing strategy around earnings. But earnings do provide some interesting opportunities for engagement, for playing your favorite stocks. Of course, this doesn't have anything to do necessarily with hedging, although you can hedge in a math-based way. But obviously, if you're in a longer-term position or you're in a swing trade and you have a big win on a low dollar cost average, you're going to want to hedge over earnings, that type of thing. But in terms of just, I want to get in for earnings and I'm playing for earnings, I think math-based is the only way to go.
Well, I can't wait to hear what you have for us.
Yeah, absolutely. So
we need
one of the big
trades, actually. We need to place the trades now. The market's still open, so.
What do we got? What do we got? Let me hold on. Let's see. What kind of interesting earnings we got? So basically, one of the big things with earnings that we all are aware of is that there's oftentimes a lot of excitement and exuberance leading up to earnings, especially if a stock is on a run or has the potential to be on a run. I'm sure you guys have experienced that or seen that. There is a name for this. You guys are probably aware of it, but some of the listeners may not be. And we basically call that an increase in volatility. So as a stock heads towards its earning date, there is very frequently, not always, but most of the time, there's very frequently a huge inflation of the volatility around earnings. And what that means is that option prices are going up. Whether the stock is moving down or up, the price of those options is going up overall. So if the stock's going down, those puts are getting more and more expensive, more so than they would be normally because of the unknown. That's what everybody's excited about. That's what gets all of the juices flowing, is we don't know what's going to happen on earnings, and it's exciting. And I hope this happens. So I'm going to, put a bunch of money on this direction or whatever. So that increase in volatility plays right into a math-based strategy. There's a concept in math-based option trading that we talk about called the expected move. Are either of you familiar with it?
Yes.
Yeah, I believe we talked about it.
Okay. All right. Well, I'll just elaborate a little bit for the sake of the listener. But basically, over every earnings move, there's a mathematical model the exchanges use to project the probability of the move in one direction or the other. And that gives us a range that we can kind of expect. The reality is, the vast majority of the time, the stock never exceeds that expected move. Now, if it does, we call that an outlier move. And outlier moves obviously happen, right? There's no 100% guarantee in the stock market. I think everybody listening to this show understands that. But in the vast majority of cases, most stocks are going to trade inside the expected move. And so what happens with earnings is you have this excitement, this exuberance, this run up. There's a bunch of unknown, the volatility spikes, and then the earnings come out. And then what happens? There's a move of some kind in either direction, but it's rarely very exciting. Oftentimes there is a massive gap down. That can happen. And oftentimes there is an unreasonably exuberant, leap up. That can also happen. But most of the time it's like, okay, we gapped up or down on earnings, whatever. And it's usually, the interesting thing is the exchanges are usually prepared for it. There's usually a range in which they expected that move to happen. And so the next morning on the open, after the earnings come out, all that unknown is gone. We know what we didn't know before. And all of the excitement and exuberance is gone. Whatever we expected to happen either happened or didn't, but we know the outcome. And so all of the volatility just gets sucked right out of those option prices. And if you choose the correct strategy, you can take advantage of that phenomenon regardless of direction. And that is the big key for math-based option trading over earnings for me. I think picking a direction on earnings is extremely difficult at best, and most of the time, most likely just a crapshoot the rest of the time. I haven't really found a consistent pick an earnings direction type of strategy, but it's not my specialty. However, if you can play earnings in a way where the direction doesn't necessarily matter and all you're hoping for is just not a shocking surprise, you're going to win more often than you're going to lose, that's for sure.
That's excellent. Now, a lot of our traders, some of the people that listen to our show, a good chunk of them are probably fairly new at trading. How many of these strategies that you would be using would be appropriate for a new trader, or do they need a certain amount of experience before trying any of these out?
I think it's a good idea to have a solid understanding of options. If you're brand new and you've never traded options before, jumping into trading options over earnings probably isn't where I would start. So yeah, I would check out the free courses in the Real Life Trading Dashboard that talk about options, the advanced trading course. You need to have a good understanding of what puts and calls do, how they interact with each other, and especially on the spreads, what a credit spread is, what a debit spread is, because it's a combination of those things that we can use to create successful option strategies.
All right, so now let's say that we do have a trader with a little bit more experience and they want to try out a new strategy. What would be your favorite, easiest strategy to try and implement and dip your toe into options trading over earnings?
Sure. Okay. So I'm going to give you basically a strategy and then the safe version of that strategy. All right. So we've been talking about how the exchanges expect a certain range of movement over earnings. We call that the expected move. So they think it's going to move at the most up one direction by a certain amount. And everybody can actually find this amount. Some people, I guess I won't say most, I shouldn't assume, I bet our readers are brilliant, or our listeners, I should say. If you look at an option chain in most brokers, you will see the volatility number next to each expiration. So if you want to know what the expected move for earnings is, you go to the cycle that the earnings is in. And if you're actually playing this the night before, which is where I think this works best, you're just going to do that week. All right. And in good brokers, next to the percentage that displays the volatility on an option chain, you'll see a little plus minus number. That is the expected move. And that means that the exchanges are expecting the stock to move up or down by that many points on its stock chart. So once you know that, you can simply take advantage of that move. And so my favorite trade for doing that is actually a strangle, which is a sold short put and a sold short call. Now, this will only work in margin accounts unless there are some brokerages that will allow you to trade these in a cash account. There's one that I know of, the one I use pretty regularly, which is Tastyworks, just for whoever is interested. But the reality is that the strangle over earnings has a win rate in the low to mid 90s, and it's because of the phenomenon that we were talking about, where most of the time, the stock is not going to exceed the market maker's expected move in one direction or the other. So what happens, okay? You have a short call on top and a short call, put on the bottom. And anybody who's traded short puts knows that you don't have to just win on direction. If the stock doesn't move past your short put, you can win just by the option simply expiring worthless. So there's three components of every option price. There is the underlying stock and what it does. There's the volatility, and then there's the time factor. And we're basically leveraging the time factor and leveraging the volatility factor on both of those options and hoping that the direction doesn't go too far in any one direction for our sake. And so what happens is, regardless of which way the stock moves, the next morning at open, all that volatility comes in. It all gets sucked out of the market. And if it's in a weekly cycle, you got a whole day for the theta decay to really crunch down on those options, which is just one of the option Greeks that basically quantifies time value of the options coming out. We're getting closer to expiration, so the value of those contracts is going down day by day. So we take advantage of that on the overnight move, and we also take advantage of the volatility coming in. And as long as the stock didn't move too far in any one direction, you'll sell that strangle for a credit, and you'll typically be able to close for anywhere from 35 to 50% of the credit you received, pretty much at open. I'm not one of those guys who tries to game the system and turn it into a fancy day trade and hedge and reverse hedge. That can be done. It certainly can. And if you like the engagement of that, go for it. But typically for the probabilities and statistics model, everything you're playing in that trade happens immediately on open. The volatility disappears. The time value gets taken out. And so if you're up within 5 or 10 minutes of the open, you close the winner and hey, great trade over earnings.
Now, obviously, when it comes to trading in general, it's not so much how much you make, but how much you could lose, right? So you're saying there's about, in your strategy, about 90%. That still leaves us a 10% margin in error of that.
Correct.
Working.
Yeah.
How do you hedge something like that and protect yourself if expected move is 7% and you have a stock gapping 20% of some wildness?
Yeah, there's a couple of things you can do there, Dan. So my general rule for an earnings trade is usually 300% of the credit for me personally. So if I sell a strangle for $5 and I have to buy it back for more than $15, I'm going to close it for a loss, and that's going to sting. That means I have 3 or 4 strangles to make that up, and that's why I typically use strangles as more of an engagement tool, and it's also why I usually only sell these in the highest of the high volatility environments. This is not a strategy that I'm going to build an entire portfolio around because, to your point, the downside can definitely outweigh the upside if you do step into one of those outlier moves. And so that's why I personally think this works best on mid to large caps. You don't want to necessarily jump into these on on the Russell small caps, because sometimes those violent gaps, they can really create problems for you. Now, there are strategies for hedging a strangle if you want to stay in it and it's going against you. You can roll the untested side. These are all concepts that I talk about in my math-based option classes. So I won't overwhelm the podcast with that. But typically the idea is to close it, win or lose shortly after open, and a big gap will sting. But fortunately, those are rare. Now, the variation of that strategy that can help with that effect to some degree would be an iron condor. So an iron condor is basically a protected, if you will, strangle. So inside of an iron condor, you have the short call and the short put on either side, but you've basically capped your losses one side or the other by buying that insurance wing further out. Now, little pro tip here: if you have the account size and you have the capital for it, and you want to do an iron condor specifically as an earnings play, I would go at least $20 wide with the width of the spreads if you can. We call that a synthetic strangle. And the reason for that is because the wider you go, the more the Greeks and the probabilities and the math factors will actually act on the trade, and it will behave more like a strangle would. But whereas a strangled has a much larger potential loss if you don't manage it properly, obviously the iron condor is capped at the width of your spread. So if you go $20 wide at $2,000, if you sell it for $5, you'd be looking at a $1,500 downside at the most, which is 300% of the credit. So that fits my rule that I had mentioned before. Now you can go smaller if you are in a smaller account. No worries about that. If you want to do a $5 wide iron condor, you can put that on, and your maximum downside there is probably $300 or $400, and you're looking to make $100. That's the way math-based option trading works. You're actually always risking more than you can make on the trade, because the stock market is a gimme and a gotcha game, right? There's always a trade-off. So in a strategy where you're going to win a lot, the price to pay is that when you lose, you're going to lose bigger than you can win the next time. So it takes a couple of trades to make up a loser.
Right. Now, this is always a difficult question to ask because it varies stock to stock to stock. Preferred volatility. You mentioned earlier that you like to stay in stocks that have really, really high volatility when you're going to play it over earnings.
Yes.
This is a relative term because high volatility in one stock may be low volatility in another, et cetera, et cetera. So I'm going to word it in a way of percentages. So if you know your stock that you're going to trade and you know what that typical volatility sits at, are you looking for a 20%, 30%, 40% increase in volatility, 100% increase in volatility? What's your favorite to consider a high volatility? That's
a phenomenal question, Tracy. And if I didn't know better, I would think that you had virtually set me up with it. But basically, that is precisely the reason that I don't look at the option chain volatility for my volatility metrics. To that exact point, volatility isn't necessarily apples to apples when you're looking at the volatility of one stock to the other. The volatility of GameStop always runs 4 or 5 times higher than SPY, but that doesn't mean that GameStop's volatility is high for GameStop. And that's what we really want to capitalize on, especially if you're using the iron condor. You want the most volatility you can so you can really suck the premium out of those credit spreads. The way that the metric that I use to measure volatility, Tracy, is called IV rank. And IV rank was created by Tasty Trade. It's similar to IV percentile, which can also be used. And what those two numbers do is they look at a stock's historical volatility within a given time period, usually a year. Well, I apologize. Market's closed, by the way. Usually a year. And then it measures the volatility of that stock against itself. So you have a baseline to know, is this high or low for this particular stock? Now, because Tasty Trade created the number, I get my number from them in their broker. However, there is a free place that I go to and I recommend students go to if they're not Tasty Trade fans, and that is barchart.com. So if you go to barchart.com, you can type a ticker into their little search box, and when you get the profile page for the stock you want to trade, there's a section about halfway down the page called Options Overview. And in that section, you will see the IV percentile and the IV rank. Now, the unfortunate thing is the IV rank metric can be manipulated a little bit depending on the time frame you choose to use. Some people will tell you they're only looking 6 months back. Some people will give you a number and not tell you how far back they're looking. Based on my personal experience, barchart.com is usually pretty close. I like to use Tasty Trade as the benchmark because they created the metric. So if I'm using IV rank as my metric for volatility, especially if I'm selling options over earnings, and volatility is the main thrust of what I am banking on for my trade, I've got to have IV rank higher than 30 for sure, and higher than 40 or 50 is preferable.
Thank you for that answer, because I have been wondering where I can find IV rank, because I've heard it before.
Yes.
And I'm going to do a little shout out to Tasty Work. Well, I guess it's not a shout out. It's kind of a request. Please make yourself available to Canadians. I would definitely appreciate it. We don't have access here. So,
absolutely. That would make everybody's life so much easier.
So thank you, because I did not know you could use bar chart. So that's awesome. That's incredible.
You did mention, so like bar chart is a spot you're going for some information. When it comes to options, Tasty Works, is that the main broker? Do you have other brokers that you like when trading with options, as far as accessibility of information that could be generated from that platform?
Yeah, the reality, Dan, is I love Tastyworks for everything I do, and it is the primary broker I use. And the good news is, if you're a U.S. resident, you can open a Tastyworks account and you don't have to fund it with anything. Now, eventually, they're going to send you an email and politely remind you that they're going to delay your data by about 20 minutes. But in swing trading, that really doesn't matter. Obviously, you could not day trade on 20-minute delayed information. But if you're looking to set up option trades and you just want to have the Tastyworks tools, they'll allow you to download the software, open an account, and you don't have to fund it with a penny. Now, having said that, I started my trading with the Tastyworks style on Thinkorswim. So Thinkorswim has a lot of the same tools, and it was actually built by the same guy. So Tom Sosnoff and his team built Thinkorswim, then they sold it to TD Ameritrade, and then he went on to build Tastyworks. So maybe that's why there's some similarities there. I know that Canadians have a similar affiliate. I have a Canadian student now who has a version of Thinkorswim, and it's through the broker TD Waterhouse. So that might be something for our Canadian listeners to look into. Interactive brokers will get the job done, but I am not an expert in that platform. It's very complex, so it'll have the tools, but you're going to have to spend some time hunting that stuff down. You're going to have to dig in, go to the little dark corners and find the information you need. That's why I try to find universal resources like bar chart if you to do what you do. But as far as me personally, Dan, I trade on Tastyworks. I use Thinkorswim a little bit for some of their charting stuff. Thinkorswim does still have some really good, really robust charts, but honestly, I don't need that in my math-based option trading. I use that more for day trading. So in the math-based options world, it's actually very simple. You need an option chain. You need to be able to see delta and extrinsic value, which is something any decent option trading broker should have. And then, a few tools here and there can be nice, but it is not necessarily required.
And just out of curiosity, when you add the call price and the put price together, does that give you an expected move?
I'm not sure. Yeah,
Okay.
I'd have to check that. I'm so used to just looking at the plus minus and kind of going on the up down from there. I'd have to see if my initial thought is probably not, because that's not accounting for extrinsic value. Which is built into the option prices that wouldn't be there in the stock move.
Gotcha.
But they're probably in the ballpark.
Okay.
But what I'd like to point out is just the difference between this strategy and the other common strategy, which is a long strangle, right? Where people like to buy the out of the money call and buy the out of money to put. And what you're playing for there is that home run hit, right? You're playing for the big, huge move in one direction or the other, and you're going to get 500% on one of those options, and it's going to pay for everything. And as exciting as that trade sounds, the mathematical reality that we've been able to measure historically is that that does not happen very often. You're probably losing on that trade probably 60 or 70% of the time.
Wow.
Yeah.
And for options where where you end up losing more than you get than you want, that's not a good metrics at all. Yeah, that's terrible.
Yeah, and it's mainly because people tend to underestimate the impact of volatility and time decay on option prices. So even if you get the direction right, you can still lose based on those other factors. And so going the other route with it, where you don't worry about the direction and you play the volatility and the time decay in the extreme, that's always been my approach anyway.
Well, and does anyone know of a broke casino? Because I don't, so I rather stack those odds in my favor. Right?
The business model seems to be working, right? They just stack those gains hand after hand, and every now and then they got to pay a big payout to a lucky winner, but nobody takes the house at the end of the year.
Yeah, exactly. Now, you have a mentor group waitlist, is that correct?
Yes, I do. My content is pretty unique in the community, so it fills up quickly. So April is already sold out. As we are speaking right now, recording this show, and I have already started my May waitlist. Actually, there's already a name or two on there. We cap it at 6. So if anybody's interested in diving in and learning more about not just trading math-based options over earnings, but also doing so in directional ways as well, they can email me. My email is robert3@reallifetrading.com, and I'll put you on the list, and we'll go from there.
Perfect. And we'll throw all those links in the description as well, and that's pretty much it. Dan, you have anything else you want to add? Or
it's amazing always talking to RT3. So just the wealth of knowledge that comes out. So yeah, I would definitely recommend if you're not on the list and you're interested at all in options, where you trade options currently and just need a different strategy, a new strategy. The one thing I will say is you did mention not going for those home run hitters, which people obviously that play the market like to. But the big difference is, do you want to hit a home run once every 6 months, or be a consistently profitable trader throughout the year? I'd rather take the latter. So I think a lot of people, once they start understanding the concept, it's a valuable tool to have. But we do have the competition still running till the end of the month. So make sure we have had a bunch of submissions already as far as trading plans. And the reason why, if you have not already sent those out, make sure you email myself, Dan, at Real Life Trading, or Tracy at reallifetrading.com, and we will add you into the pool of people that we've gotten already. But it's been good. RT3, pleasure having you as always. Tracy, great hosting. And for all you guys, thank you for listening once again to the Pivot Podcast. We will catch you guys next week.